Thank you for joining us. It's a pleasure to have you with us here today. We have an exceptional panel of pioneers in this impact revolution that we'll be talking about today in building a pipeline to and some bridge to the future in a more inclusive economy. We have an exceptional panel of pioneers in the areas that have been addressing these urgent issues for years, and of how financial innovations really enable us to manage this perfect storm of the convergence of business, social, environmental, and health risk that we're facing today. The work here at the Milken Institute has always been infused by this idea that financial technology can act as an accelerant and be able to mobilize human and social and natural capital and real assets in order to generate growth. So welcome to this discussion about the impact revolution. A couple of housekeeping points. This call is being videoed and recorded, and it'll be made available on the Milken Institute website shortly. You can submit questions at the bottom right corner of the screen through the Q&A feature. Each week, we've had a diverse group of leaders exploring a different industry or region or sector that's responding to the challenges and outlining some creative solutions to these matters that really are part of the DNA of our work here at the Institute and the positive impact to these challenges. Previous calls have covered everything from vaccine development to strategic philanthropy to market implications of the coronavirus. And future calls will focus on ensuring access of capital, which is a long-term issue for us, not only for minority-owned businesses, but for emerging domestic markets within the United States and in the emerging and frontier markets of the world. This has all been part of what we talked about as the democratization of capital, to be able to finance ideas if we can move forward on the slides we have today, and into the democratizing access and the growth role of innovative finance. We're now really in this long arc of financial history and building novel financial structures to expand capital access. If we look just at the 100-year period between mid-century, 20th century to mid-21st century that we have ahead of us, we're looking at how these novel access has been able to deal with social and environmental risk, and now we know painfully how that's related to health risk and systemic risk as well. So how do we answer the major questions of financially innovating the future? How can we lower the cost of capital and the allocation barriers and remove them? In the period between 1945 and 70, into 1970, dealing with the equity markets and IPO markets were very key, dealing with some of the issues that we had in interest rate derivatives and managing inflation risk. And then during the corporate financial revolution of the 1980s, where basically we were able to undesign the redlining that was going on in limiting capital market access, whether it be in the housing market, where housing discrimination was and continued to be a problem, or it was into the business access market of opening up the corporate bond market. That led us to venture capital and private equity and the birth of the technology booms and reinventing companies and reinventing industries to where we are today in the extension of that logic into impact investing, dealing with environmental finance and social finance as well. This topic has moved from a niche issue to a mainstream issue. It was preoccupied with many of the concerns in the Community Reinvestment Act and the Home Mortgage Disclosure Act in order to deal with disclosure about lending into program-related investments by a number of foundations that have been able to move forward in program-related areas to a niche investment that would have medium risk and the like, but now to where it is being mainstreamed in terms of risk-adjusted projects with high impact and sustainable impact. Over the past 2 years, the ESG market's grown from 22 million to over 31 trillion. It's 15% of the world's investable capital. It's doubling annually and is up to $715 billion, just focusing on the impacted investment spaces that's been defined. So we're talking about a forward-looking methodology that's emerged to estimate financial value of capital, not only on terms of financial returns, if we go to the next slide, but looking at risk, return, and impact. And it is at this what Sir Ronald Cohen has described as the triple helix of risk, return, and impact, or as former Secretary of Treasury Lawrence Summers talked about it as ground zero of a very big deal, of looking at the aggregate evidence that comes into this. For 100 years, finance looked at risk and return. Now we're understanding that impact really conditions this whole process of risk and return can maximize it and amplify it. In terms of 2,200 different financial economics research that you won't have to read, but just to summarize quickly, 90% of the findings show non-negative results on return, and 60% show positive results, impacts on return. And this is where we meet the next question of designing the capital structures that are necessary for this. And this nexus between results, outcomes-based financing, impact investing, and blended finance coming together, and it's come together wonderfully in this in Impact and Reshaping Capitalism to Drive Real Change, and this new book that we were going to talk about next in introducing Sir Ronald Cohen. There we see this book was just released in the UK this month, and in the United States in the fall. And I want to just turn it over to Ronnie now to just talk about his journey and how he has dealt in his career and in his vision of and in defining the impact revolution.
Thank you very much, Glenn, and thank you very much for setting the scene so well. It's a great pleasure to be on this panel with you, with Cynthia, Julie, and Renee today. I think, Glenn, while we've all seen in the investment world, investment themes come and go. Every few decades, there can be some major changes in the way in which we look at investment. And I think we had a major change like that in the 1950s, when academics at the University of Chicago began to measure risk. Up until then, every investor had thought of risk as something in the background, going back for hundreds of years, but nobody had been able to measure it. And the implication of measuring risk turned out to be absolutely huge, because when we began to think in terms of risk-adjusted returns, we brought the concept of diversification, that it's possible to include in a portfolio asset categories that have high risk but deliver inordinately high returns relatively to that risk. And that by diversifying a portfolio into higher risk categories, you can actually improve the return, the risk-adjusted return of the portfolio. Now, that change in thinking really opened the door to venture capital and private equity and investment in emerging markets. So it led to the tech revolution and to globalization. And I think what your chart shows is a different way of investing along these decades. Actually, at the end of your line of investment development comes a major change, I believe, in the way in which we view investment, which is to begin to measure impact alongside risk and return. And that has very far-reaching implications again. I think it opens, as I say in my book, the door to an impact revolution, which is going to be as far-reaching and disruptive as the tech revolution was. Because when you begin to measure risk, and technology and the availability of data helped us to do that, you begin to change your portfolios. And when you begin to measure impact, and again, technology's moved on, and today's technology and data enable us to measure the impact of companies, the impact from their products, from their employment, from their operations, on people and the environment. And if you begin to think of a world where you're using impact-weighted financial accounts that take into account the pluses and minuses that different companies deliver in terms of impact on people and planet, then they will begin, these accounts will begin to affect the investment decisions. They will begin to lead investors to companies that develop impact models that are able, I believe, to deliver even higher growth and financial returns, as well as impact. And we will begin to look at companies in terms of whether or not they are net impact positive, and if so, by how much. Now, we haven't been aware of the figures that can be put together, but there's a big effort I've been involved with at the Harvard Business School called the Impactweighted Accounts Initiative, which has taken public information and just published last week the environmental cost of 1,800 companies in descending order of damage within their industry groups. And if I mention in the book that you look at the fossil fuel companies within that database, and you look at a company like ExxonMobil, and I'm not in favor of investing in fossil fuels, but for those who want to, or those who want to look at the costs that fossil fuel companies bring in their trail. If you know that ExxonMobil, through its operations alone, delivers $39 billion of environmental damage a year, and that compares with Shell delivering about 23 billion, and with BP delivering about 13 billion, that's information every investor should have. And if you look at diversity, if you take a company like Intel, which has been a leader in pushing diversity within its ranks and the well-being of its employees, and you look at the wages that Intel pays its employees in the United States, $7 billion a year, you might superficially think, wow, that's fantastic employment impact. But if you look at the demographics around its facilities and the representation of minority groups, and you compare that with the number of people employed from these groups within Intel, this contributes to reducing the positive employment impact of Intel from 7 billion to 2.5 billion. And so if you can imagine adding to that, which we will do next year, product impact, then you can begin to see the total impact that the company creates. When we get to impact-weighted accounts, is obviously a very big question. And I believe, Glenn, that we are at a historic crossroad that is similar to the one our predecessors faced in 1929. After the great crash, investors came to realize that they had been investing in companies without understanding what profit they really made. In those days, every company could pick its own accounting policies, and there were no auditors to verify the numbers. And at the time when people began to push for generally accepted accounting principles and the use of auditors, there were representations made in Congress that this would spell the end of American capitalism. In fact, legislation passed in 1933 to bring GAAP accounting and auditors in, and we know it led to the huge development of our investment markets because investors could rely on the accounting. And I think after COVID-19, we're at a similar historic crossroad because $30 trillion are going to ESG investing. Another 700 billion, as you were saying, is going to impact investing, where you have the same intention as ESG, but you want to bring positive impact and you measure the impact that is created. So more than 30 trillion is being invested today. As you say, 15% of investable assets in the world, equivalent to twice that, 30% of all professionally managed assets in the world, which is going to investment in companies that are achieving more than just profit. But we have no transparency, just as in 29, we had no real transparency on the profits companies made. And so I think we find ourselves in a position now to push hard for our governments to mandate that companies starting 2 years from now must publish impact-weighted accounts. If we get to that, we will bring impact to the center of our economic system alongside profit. We will turn our economies from engines that are creating huge problems today, environmentally and socially, which governments are taxing us all in order to try unsuccessfully to remedy them, to huge engines for bringing solutions to the problems we face. And I'll close with this then. The reason we've got to $30 trillion plus of investment that seeks impact as well as profit is values have changed. The new generation is purchasing products from companies whose values they share. They're working for companies whose values they share. Investors are showing preferences now for companies whose values they share. And at the same time, governments are becoming aware that they will need to regulate and to tax companies that are polluting or doing socially unacceptable things. If you begin to think in terms of risk, return, and impact, you open the door to huge sets of new opportunities, which we can talk about in the rest of this panel. And I believe, as Michael Porter, famous strategist at Harvard Business School, has said, that impact will be as disruptive as technology was in creating profit and growth in the future.
That's a really profound introduction to our conversation. And I'd like to invite our other respondents to join us now, because we really want to move on first with Cynthia Muller from the Kellogg Foundation. And Cynthia, if you could just tell us a little bit about your perspectives on this. We know that, as we've been mentioning, this whole issue of transparency, of being able to make sure we can measure and manage, and by monitoring the nature of impact and what kind of value that it can create in terms of economic and financial and social and environmental value. We've got these capital gaps now that really create social cohesion gaps as well, that we can very ill afford if we're trying to grow the economy or keep growth alive in the 21st century. How have you approached this whole question of the relationship between growth and equity in your impact work?
Thanks, Glenn. And it's such a pleasure to be here with you and the Milken Institute and Sir Ronald and Julie and Renee today. I'm Cynthia Muller. I'm with the W.K. Kellogg Foundation, and we're a 90-year-old foundation whose mission is children. Children are at the heart of everything we do, and children live in families, and families live in communities. And so for all children to thrive, for us, families must be able to support themselves and their communities to be equitable places of community. And so building off Sarani's framing, for us, it's around how do we create better practices that can be adopted by these companies? How do we, in our very privileged place of being a foundation that gives out 5% or more every year, but also sits on this 95% and the rest of the 95% of our assets, and how can we think more intentionally about how we use those resources? And so 13 years ago, the foundation allocated a $100 million allocation out of our endowment towards impact investing. Now that's not a lot today, but 13 years ago, it was quite something. And for us, it was really a part of our contribution to understanding how can we maximize this incredible tax structure that we as foundations have, and how can we use that role to influence the broader capital markets? And so I lead a program called the Mission Driven Investments Program, which is right now about 150 million in outstanding investments, both below market rate and market rate. And our mission is really to use all of the tools that we have available. So while we have below market rate investments, we use, as you mentioned, through the program related investments tool, we also look at the traditional investments. And so while we're seeing this dearth of great interest and activity, we still have a lot of practice to build. We still have a lot of details to work out as we understand how we come into communities and who is benefiting and who isn't in every transaction. Because we know that there are tremendous externalities, even more so that we're more aware of over the last few months. But I think for us, it's really helping our investors to see those and to account for those earlier in the investment process. And so for us, in our humble role as a foundation, working with groups like Julie and with Renee, and really playing that role of coach, mentor, and supporter, and as well as investor, to help them graduate and to help for greater adoption in the broader public markets. So for us, it's really digging into kind of the broader practice, and then even a layer deeper, racial equity. So a number of years ago, we as an institution embarked on a journey to learn more about the role that race plays in all facets of our society. And I think today we see a lot of the results of that work. Within our portfolio, we are very much focused on racial equity, but I think we think about it a little bit differently than I think it's being presented in the field, in the sense that we see it as opportunity. I think we have an opportunity here to reframe risks. To Sarani's book, we understand risk in a very, very linear way. And I think what racial equity allows us to do is allows us to see more the 3D dimension of the way that society actually works and the way that capital actually flows. And I think while impact investing as a field has been one where we have been incubating and getting a lot of incredible scale and results, we still have areas of efforts that we have to work on. And our role with our portfolio is really to build out that practice. So I'm really excited to talk a little bit more about that today and to hear.
In your look at the relationship between equity and growth, how much growth are we losing by the absence, due to the absence of equity?
So we're losing, we have run the chance of losing a lot. By 2050, people of color here in the United States will represent more than half the total US population. And so obviously, if you have a society that hasn't been represented in the capital markets, in every other facet of the economy, there's a lot of tension there. So when you think about the broader opportunity, it's several trillions, $70 trillion that we anticipate in additional economic activity as a result of a deeper racial equity lens. And so we think that that's definitely something just as significant as all of these other milestones, but something for us to think about and for us to practice and to strive toward.
Let me go back just to a little data about these questions of size that we have in looking at this market. And this Pensions and Investments provided us with some summary of this last year that's been updated of around 21 trillion in the public markets, about 5 trillion in private markets, a stake on that slide, and then a total of around 26 trillion available to 32 trillion today in terms of the potential size of the market. The 715 billion that Ronnie had mentioned, the assets under management by the largest pension funds and sustainability, all of these are factors that we look at. But if we look then in terms of the allocation and building the project pipeline, because we don't want to just talk about what our goals are, but indeed about what the solutions. In some of just a little survey we did on and some training we did down in South Africa last year, just looking at the amount of assets under management and the amount of commitments, what are the bottlenecks that we're dealing with here? How are we going to be able to accelerate growth? And especially in this crisis, what have we learned about this process? And if we look at it from, and we zoom out a bit into the future of bond markets generally, and then I want to move to Renee, because his work and has been so path-breaking, both at the International Capital Markets Association of providing us with this categorization of the different lenses of looking at the way that we can mainstream impact investment and development finance, but also his work at the European Investment Bank, which was quite innovative, and then in his engagement with IFM and the Global Alliance for Vaccine Initiative, 10 years ago, in terms of its breakthrough work, which is so relevant today in the crisis we face. Renee, let me turn it over to you just to talk a little bit about how this rolls out in terms of implementation. How do we move to solution sets and to securities that represent the pooling of this risk and being able to finance our way through it?
Thank you, and thank you for your invitation. It's really a pleasure, a privilege to be with Ronnie, Julie, and Cynthia today. I've been privilege as well to be involved in the emergence of these experimental transactions 15 years ago with IFIM, you mentioned, the International Finance Facility for Urbanization, which is widely credited for the very first social bond back in 2006. And in 2007, the first green bond was issued by the European Investment Bank. And these, at that time, were experiments, but also responding to demand which was emerging from investors, particularly from retail individual investors, and it was also a generational demand for this kind of impact product. And then I've been also privileged to work with Ronnie in his task force for social impact bonds. Now we see this market, and the figures speak for themselves, taking quite a level. The question, the challenge now is, what are the main key aspects to bring it to mainstreaming sustainability in the financial sector? And for that, I think, and Ronnie has mentioned measuring impact, there are two aspects, in my view, which are critical. One is the standardization of the definition of the products, mostly in the bond market, and this definition has been a task which my institution, the International Capital Market Association, has done by putting together the principles for sustainability bond, for green bond, and social bond. These are very important aspects because it brings economies of scale. Standardization also brings comparability among the investors. And I'm pleased to report that more than 85 to 90% of the bonds issued in the green and the social have been issued under the green and social principles of the market. What's important also, and governance in particular, are also moving into standardization and regulation. This is the case, particularly in Europe, and with the EU taxonomy, as well as standards which have been announced and put together. And this is an important element. But another aspect which is also as part of this standardization is also measuring impact. I think this is critical. This is the third dimension mentioned by René. This is a very important element. And I think our principles are bringing also what is needed in terms of external reviewers, evaluation, which are compulsory, or when you issue bonds, and independent second opinions. This is important because it brings more transparency and lead the way to also to provide better measurement of impact. The second challenge, in my view, is in order to meet the demand, is to provide also innovative and new products. And this is very important. And this range from the traditional plain vanilla bonds, which are a destination of proceeds which is well defined, green, social, but also recently, for example, give an example, there have been some sustainability linked bonds which have been issued, which provide a performance or a return to investors which is directly linked to pre-agreed objectives for a company, for example, or for an issuer. And this is very important because the investor will share the success or not of the institution to meet these pre-agreed KPI, performance indicators. And we are helping the market by issuing standards of market standards which have to be followed. I think for me, this is an important recent innovation because it provides a link, a bridge with the social impact bonds, which were invented by Ronnie and his task force some few years ago, which provide a return for investors, which is directly linked to the performance of an institution, of an issuer, in relation with their meeting pre-agreed objective in terms of sustainability. And I think this is really the third dimension in terms of impact, which thank you.
That's very, very helpful. We're just right about at the halfway point in our discussion, which hopefully is the a renewed opening of a longer conversation about the implementation stage of this change and the pivot point that we're at. But for those of you listening, we'd like to remind you just to submit any questions you have for the panelists in the Q&A function that it's at the bottom right corner of your screen, and we'll be collecting those. Let me move on just to look at for a moment the key focus areas of this discussion of sustainable impact. In the next little slide here of the areas, what are the target areas that we're interested in focusing on global health and on affordable housing, education, gender equality, and women's empowerment, the whole question of sustainable infrastructure in addressing climate change and the development challenges and community development, environment and energy more broadly, sustainable development and products and services. All of these areas have been an area that are very key to the work that Citi has done. And with that, I want to introduce Julie Monaco. It's really, along with the other folks on this call, it's been a real honor to work with Citi on so many of the innovations labs that we've been doing in Israel, in the United States, and elsewhere, but targeting questions in terms of global development in Africa, as well as financial inclusion. All of these areas, and being able to get to scale in any of these products in order for finance to really effectively be an accelerator. The financial accelerator is the missing element, especially if we try to look at recovery. And I'm glad that Ronnie brought us back to a discussion of how did we manage our way through the mid-20th century crises, and what lessons can we learn and avoid in trying to move forward from the challenges we have right now. So Julie, maybe you could talk a little bit about you provided great leadership there at Citi in financial inclusion in the whole areas of development finances. You and your colleagues from London and Israel and elsewhere have joined us, as did Renee, on working on our new development finance institution that we're working on in Israel, and some of the programs that would work as platforms, as well as with Ronnie, and the work on a social capital markets launching in terms of funds, in terms of facilities. And I'd like to move the conversation again to these practical moments of what is the game plan as we navigate our way through this crisis.
Okay, well, Glenn, thank you very much for having me on today. And I think, when we hear the other panelists, when I'm listening to Renee talk and I'm listening to Cynthia talk, I realize that, Citi, we have a very unique platform and a very unique vantage point that we look at all of this development and impact finance, because we're heavily engaged in everything Renee is talking about in terms of being a lead bond underwriter and being right there, and as excited as you are about the sustainability linked bonds and how we're moving that industry. And of course, we have a very large foundation, Citi Foundation, that does a lot of initiatives that Cynthia talked about it. But I'm going to focus on a few other areas because I think it'll just a different angle of it. So first, Citi, having impact investing and using the platform of Citi for impact investing really has been part of our DNA for a long time. So for more than 15 years, we've had a group called Citi Inclusive Finance. It was originally called Citi Microfinance. And so for the last 15 years, we've been enabling clients and partnering to scale delivery of products and services that improve their livelihoods. And we focus on low-income communities and advancing economic progress in what we consider underserved markets. And this is a global unit. And since its inception, inclusive finance business, we've mobilized $4 billion for more than 150 inclusive finance clients. And what we do is we work to advance inclusive finance, leadership, and strategic financial contributions to different organizations. And we continue to focus the efforts on working with financial institutions, corporates, and social enterprises who are going to do on lending locally to have an impact. So I think that that's one area, inclusive finance is one area and one business unit within Citi that operates that. We also do partnerships. So, we partner with, all the development finance organizations around the world. I'm going to just really give one example is we've had a long-standing partnership, which is now the DFC, the International Development Finance Corporation, which brought together OPIC and USAID. And so the DFC, is committed to many different areas of modernizing development finance and enhancing impact investing. So one area that we've worked with them and we partnered with them on is their 2X challenge, which calls for the G7 and the other DFIs to collectively mobilize about $3 billion in commitments to provide women in developing country and markets with improved access to education, to employment, to finance and financial services. So we have Citi and DFC, we have had a sort of an unmatched track record of mobilizing capital in underserved markets. So since 2008, we've executed almost $3 billion worth of transactions in financing that are authorized by DFC and in support of more than 40 projects. And what we do is we disperse millions to, inclusive finance companies in 27 countries that reach millions and millions of low-income women. And that's just one example of some of the projects that we've worked with the DFC on. And then another area that's within Citi is our Citi community community development, and that's again.
Can we just stay with this slide for just a moment?
Sure.
I just wanted to point out to our audience, these map very closely. The notion of having inclusive economy is very much tied to what the unrealized potential of growth is in these sectors. These are really not costs to the global economy, but the absence of growth increases the cost to the economy. If we don't have an inclusive economy, we don't have much of an economy left.
Right. I probably should have touched upon that. I mean, I could talk about, just to give examples of some of the sort of the key transactions. So, some people say, well, exactly how are you doing this? So I'll give an example in Paraguay in 2018. Sure. Where we basically, Banco Regional specializes in serving Paraguay's agricultural sector in their rural communities. And so financing is used towards strengthening that agricultural sector, but more importantly, it's lending to SME borrowers, and particularly those led by women entrepreneurs. And lending also to SME green projects, which improve the environmental sustainability of agriculture. And so they became a member of the Global Banking Alliance for Women, and we, with DFC, lend to them to do on lending to those SMEs. Similar type of, we were a arranger for $100 million transaction for CalBank in Ghana. Again, the financing is supporting growth of SMEs. So what we do with these lending programs is we're sharing the risks with DFC on these programs. And so it's a risk-sharing partnership that we do with DFC, but it's allowing us to on-lend to financial institutions that are in a better position to do the lending locally. And then, so I think that those are some good examples. I think another one in Brazil, probably a good example, is that Banco Crossroad Secreti in Brazil. It's one of Brazil's largest credit union alliances. And so co-financing, we did co-financing there with JICA. So that's a good example of what we do at Citi is we look at all the different development finance companies around the world and look to partner with them on where they want to be investing their development finance dollars. And what we do is we mobilize the private capital for them. And so on this particular transaction, it was really, this was done this year. So it was during sort of this unprecedented time around COVID. And with this co-financing, we were able to, demonstrate a commitment to renewable energy. It was a renewable energy project for solar projects in northern Brazil in poorer communities. So I think that that's just a perfect, way to just sort of demonstrate the way our business units, because sometimes it is inclusive finance that's working with these development organizations, but sometimes it's actually our business units. It's our export agency finance. It's our trade finance business We have people in those businesses that do deals directly. And it's deals that we're trying to get done in the communities where we are, but maybe there's a risk sharing, or we just can't get that transaction done without some development finance money coming in on a first loss or on a guarantee for a portion, and it allows those projects to get done. So then, another just sort of example is, as part of our ongoing effort around inclusion and resilience for the communities served, we've had a longstanding focus on affordable housing, and that was one of the things that you listed. And City has been working to help address affordable housing crisis by financing projects in low-income urban areas and developing new models to strengthen affordable housing. So in 2019, we provided $6 billion in loans for affordable housing projects in the United States, in close to 200 cities. And that made us the leading financer of affordable housing in the United States for the 10th year in a row. And that's something that we're very proud of. So we offer a range of housing financing solutions to affordable housing developers, with a focus on projects that serve the low income and special needs population. And, a quick, case study on that is that, and this is something that, again, we're very proud of, is that on any given night in the United States, an estimated 38,000 veterans are homeless, and many of them are struggling with disabilities. And so since 2012, we've supported the National Equity Fund's Bring Them Homes initiative, which finances and facilitates and advocates for affordable housing for veterans. And so to date, we've been able to finance about 5,000 affordable housing units. And about 4,000 veterans have been completed through this program. So that's an example of, some of the different units and what they're doing. So I think that's now building upon that. When we talk about how do we innovate, I mean, these are, like I said, that's the foundation, and it's part of the DNA of City to constantly be figuring out how to use our platform for doing well while doing good is the way we like to think about it. And so we have these units devoted to these types of initiatives. But then we have to think, we have to do more, right? We're all trying to figure out how do we do more to achieve the SDGs that you talked about on the previous page. So scaling enterprise, which is the next page, which is the next slide. This is a platform approach, and it's sort of, it's one of our best innovative examples of work we're doing to amplify investing. So building on the track record we already had with inclusive finance business and the that we had with DFC, we created a multi-sector partnership to provide funding to social enterprises at scales. And this came by bringing 3 like-minded organizations to accelerate the bankability of scaling companies that are going to drive inclusive growth and serve that last mile. So it was a combination of our City Inclusive Finance Unit, Ford Foundation, and the U.S. and OPICS, the U.S. Development Finance Corporation. And it was a $100 million loan guarantee facility that enables City to provide early stage financing in local currency. This is important, especially when you're operating in developing markets. Local currency. So
you didn't have that risk exposure, right? Great.
Yeah, to the companies that expand access to products and services for low-income communities. So the scaling enterprise will provide loans and working capital in that local currency at affordable rates to early stage social impact companies to achieve scale and greater efficiency. So I have 2 transactions that I can give you as examples, but the financing is focusing on access to finance, agriculture, energy, affordable housing, water, sanitation in any low-income households in emerging markets. So this is an emerging market example. And we're very excited about it because to me, it's sort of the beginning of blended finance when you start combining a commercial bank's money together with the development finance organization's money and a foundation, because all of us are taking a different portion of the risk. So the first one is in Kenya, and this is about expanding access to renewable energy. So City Kenya committed $5 million in working capital financing to D-Light, a global leader and pioneer in developing solar-powered solutions designed for households that lack access to energy. And it sells solar lanterns and home systems in more than 60 countries, and Africa represents majority of its sales. So the facility will allow D-Light to scale access to off-grid renewable energy in Kenya. And so, with this platform, we were able to structure a facility that made sense. Another example is in City, India. We extended a $5 million loan, again, local currency, to INI Farm Expansion, which is a banana and pomegranate company, but that sources and processes exports from smallholder farmers. So the financing will help the smallholder farmers access the export markets, which helps them increase their revenue by 20%. Just this week, we closed a deal for Sub-Saharan Africa that produces ventilators and equipment and administers anesthesia, which is filling a critical group gap for that area. So I think that a lot of the deals I highlighted is about energy, agricultural, and healthcare. And these opportunities that are in our pipeline are leveraging, innovative technology to promote inclusive business and supply chains. And so, I could go on and on with the examples, but I know that we're short.
These are great.
But
these are great examples. I'm sorry, go ahead.
Yeah, some ideas on that. And I think that, the next thing I want to talk about is really just what an opportunity we have now to really take the next step around blended finance. So the public sector has a wide variety of tools available to mobilize private finance. And this is really the topic, Glenn, we've been talking about this for years, right? So deploying thoughtfully, commercial capital is responsive to guarantees, tax incentives, and targeted insurance subsidies, such as political risk insurance. Blended finance structures in particular have enormous unrealized potential to guide private investments towards sustainable development and towards us achieving the SDGs. But regrettably, what we have found is that DFIs and donors have yet to design and fund blended structures at scale. And this is something that I think now is the moment for us to really figure out how to solve this. There's no authoritative hub to facilitate sustainable blended finance transactions at scale. And we've tried, there's different organizations that have tried to figure out how to do this. And there's other, I think impediments is that there's a lack of political will, but there's also a mindset with when you get into the public sector, that public sector feels they own development, and the metrics that need to be modernized are going to include KPIs, incentives, and penalties that the private sector is going to want in order for their capital to be deployed in this way. We find that that the COVID crisis has compounded the challenges in terms of the need for blended finance, because of the fact that you're going to see urgent need for collaboration because of the fact that sovereigns are just going to be fiscally challenged. The diminishing fiscal capacity of sovereigns is going to impede the deployment of capital for the emerging markets development if we don't figure out how to do blended finance. So we need, and we talked about the pandemic has driven global GDP.
Right. Let's dive into this some more into the question period.
Yeah.
Julie, they're excellent points, because if I just to summarize where we've gotten so far, this whole idea in blended capital of trying to take concessional capital from the government or from multilaterals, bilaterals, and philanthropic organizations, and then leverage that to absorb losses for more risky investments, but to make them into investable projects. That is so key, and it's the key of the work that we've done in the project development lab we did with Power Africa at the City Lab there in Tel Aviv. After that MOU was signed, or the work on trying to come up with investment fund and product structures that Ronnie's and social finance has been working on in Israel and in the UK and in the US around the issues of racial inequity and of the cohesion gaps we talked about. But let's turn it over to just some of the questions from the audience. One of the issues that questions that came in is that one of the issues that one of the audience members says is missing when we think about impact is that we're looking mainly at the flow of finance, but the access and technological infrastructure is key to scale. How do we get to scale, which I think is also what we've been discussing. But what is the role technology can play in the impact conversation, and perhaps scale what we're trying to do? Maybe I'll go back to Ronnie on that question. What are the practical mechanisms that can be developed to provide urgently needed financing in renewable energy projects in Africa or other developing nations? We heard a few examples from Julie, but Ronnie, how do you see this integration of technology and finance together and having a big impact on this ground zero of the big deal?
What I see, Glenn, is that technology over the last 4 decades has really created the water on which every ship must sail today.
Absolutely.
Okay, there's no way that you go into business or thrive in business without taking technology into account. I think impact is going to do the same. I think it's going to be another layer of water on top of technology on which every ship must sail. I think we're going to move to a world where just making money is going to be frowned upon. And you have to find a way of making money and improving lives and the planet at the same time. Now, when it comes to issues like, say, education in emerging countries, where we have tried for years to throw money at the issue, and there's a general sense of disillusionment today about what results you can achieve. I think innovation from impact investing can reverse the direction of travel. We can do within education what's been done within health, which has attracted 10 times the amount of money to emerging countries that education has done. And we all know, of course, on this panel that education is the single most important lever for social mobility and economic mobility. Now, if you compare an impact investment approach to a traditional philanthropic approach, in a traditional philanthropic or aid approach, you would put $1 billion and fund the activities of delivery organizations, generally charitable organizations. You take an impact investment approach, you would create $1 billion outcomes fund, which gathers money from aid organizations, philanthropists, governments where the interventions are taking place. You would sign contracts with the delivery organizations. So I've been catalyzing with my hat on as chair of the Global Steering Group for Impact Investment, $1 billion outcomes fund for education in Africa and the Middle East, and another $1 billion for India. The first two projects are getting underway. You sign a contract for $30 million to take 300,000 children who are out of school or not learning in Ghana to finish their primary school or secondary school, to simplify things. The charitable organization that signs the agreement with you, armed with this contract, which has in it certain targets, as Renee was saying, according to which you get paid, takes this contract and goes to a development impact bond fund launched by UBS and Bridges Ventures. It's one of the efforts that's taking place now, to back impact entrepreneurs that use technology and every other innovative approach to improve the learning within state schools. So the philanthropists and the aid organizations have transferred the risk of delivery to the investor. The investor is looking at making an uncorrelated financial return of 5 to 10% in dollars, depending on how many kids actually make it through their education. Now, you wake up in the morning as a delivery organization, you have clear targets, you have total flexibility in the way in which you use technology or other forms of innovation to achieve your results. You know that if you're successful in paying 5 to 10%, you're going to be able to raise twice as much money in the same way that the business would the next time around. So I think innovation and technology are going to be at the core of the ways in which we tackle social and environmental issues. But we also need to innovate in the financial mechanisms that we use. And pay for success and scaling up the pay for success instruments that we have developed requires philanthropy. I'm looking at you, Cynthia, because you're very interested in, in children, to think differently as well.
That's a brilliant point. Let me just turn this back to Cynthia.
On that point, I think it's fascinating because one of the things within this field, I think there's a tremendous opportunity with technology, as Sir Ronald mentioned. And for us, we look at it a little bit differently. We're actually looking at technology in terms of agency. we don't have a lot of levers for Black and brown and poor populations to pull on. And data, quite frankly, is one of the last ones. And I think for us, technology has provided a moment in time that has provided us a real opportunity to drive true practices that create equitable opportunities. So while we are looking at scale, I do think that we still have to look at how do we understand who's benefiting and who isn't. So while we are going into, so for us, when we go into communities or we go into funds, like for example, Operator Collective, which is a great venture capital fund, does not identify it as an impact investor or impact investing at all. In fact, it's a traditional VC fund created by a female founder whose notion was, listen, there are a lot of operators who don't know how to get access to the venture capital market. They're brilliant folks. They're the ones who scale the Facebooks and the Slacks and all of these great, incredibly data-rich organizations who have a lot of power and influence. So why we can take and harness the intellectual capital of those innovators to drive into new companies. And I think for us, it's really not only this meeting the scale of what with the social impact bonds, which I think are doing fantastic, but I also think we have to look at the practice on the ground even more so, because I think we have such great evidence at the ways that the systems have broken down over the last few months all over the globe. And I think for us, it's really helping our friends at Citi and our other development agencies understand what those dynamics are and how they can scale it in a way that's not harmful or continuing to perpetuate further harm into these communities.
Let me just close with this question to Cynthia, and maybe Julie and others can respond as well. But if we look at how do we create complete capital stacks? I think you've been doing a lot of that, Cynthia, there at Kellogg, and Julie, in terms of larger project bonds. How do you look at pulling the levers that create the capital stack in a way that allow for the risk sharing to occur on an investment like you just mentioned?
Yeah, I think this is what's really exciting. And I think, for all of the folks on this call and the practitioners out there, I think this is what we've all been pushing for, is clarity, even deeper clarity and nuance around how each one of us can come into play, right? So when we go into a fund with Julie, we know what Julie and Citi's targets are. We also are recognizing what our targets are, right? And it's that constant nuance and education. And I think, Sir Ronald and many others have done such a tremendous job in amplifying that. I think it's just getting more and more practice and more institutional awareness of how to integrate this. Because I think what we did in the early days of impact investing, we said, this exists, do it. And I don't think we spent as much time really thinking about the implications of switching an entire capitalistic market that's been baked on systems and processes over decades and centuries. And to upend that is going to require more than the moral imperative of doing good. It's going to require, there is actually incentive here, and there is actually money on the table that's being left behind by folks who are not aware of it. And I think all of us have great affinity to deepening that awareness for ourselves and for everybody.
Any final comments from our other panelists?
Yeah, no, I would just, add that, I agree with everything that's been said, but I think that one of the things we're really trying to tackle is to be more impactful. We've got to, at some point, achieve scale. And so one of the ideas that Citi's been socializing is the creation of a blended financing fund with the international development community. So sort of building on having multiple partners, creating a development fund. It would be targeted broadly at the SDGs, and we could even have a blended COVID fund, as many of the AM countries are facing a funding crisis. But we're saying if you contractually committed donor capital, it's a possible way to mobilize investor liquidity into healthcare, into accelerating funding needs. And we've identified a number of structures where donors and development funds can partner with various parties across the public and private sector to increase their investment in the SDGs, which is becoming, there's more and more of a demand for that. So we believe that a blended fund really could help us establish a way to ensure accountability, transparency over these projects that are financed, as well as have a more fair allocation of risk between the public and the private actors that would get engaged in one of these funds. So we do, come back to, we're going to continue to push hard, and we hope that this is the opportunity because, we say necessity is the mother of invention. The necessity is there now. We need to figure out a way to come together and do more blended.
It was always a good idea. No, we don't have a choice. So,
yeah.
Renee,
Exactly.
any last words?
There's just not enough funding. There's just not enough public money funding to do what has to be done.
One aspect which is very encouraging in this efforts to mainstream sustainability in the financial sector is the broadening of the participants.
Yes.
Both at the private sector level, but also the public sector, of course, in addition to philanthropy and the corporates and so on. I'll give you an example, the role of central banks, regulators, and public institutions. About 50 central banks and regulators set up a network, NGFS, Network for Greening the Financial System, sustainability in the system. And I think what they are doing is not only expertise in terms of regulation, in terms of the public sector, but also they are committed to bring sustainability in their own reserve. This is an example of how this market is getting the mainstream, and also the broadening of the participants, the level of the investors, issuers, intermediaries, and participants. And that's
Ronnie?
Yeah.
Ronnie, any final words?
I think it's been a great panel, and I think the optimistic note that all of us share is because we sense that the momentum is really growing. And I think if we can all put our weight behind these efforts to measure impact, to get significant impact flows, to get innovation going, then we have a chance for a major breakthrough. But if we want to get the whole of our economic system to go in this direction, we have to get to impact-weighted accounts. And that's, in my view, the key priority for all of us to strive to achieve.
Well, thank you all. This really was a great discussion. We're going to continue this discussion on August the 11th in a conversation about investing for impact in emerging and frontier markets with our partners at the U.S. Agency for International Development and the International Cooperation Agency, Mashav, in Israel. We'll have a discussion continuing there on development impact. I want to thank all of our esteemed panelists who are activists in this period of time. And to find out more about their work and support their ongoing efforts to build the investment pipeline, please look at their respective organization websites and visit milkeninstitute.org to learn more about what the Institute's doing on these challenges, especially on COVID-19 treatment and vaccine tracker that we're maintaining, and access to all our previous conference calls and webinars, including the podcast with our chairman, Mike Milken, and many other array of thought leaders. For anybody who'd like to get involved in the work, please feel to reach out to me or my colleagues at giego@milkeninstitute.org or Glenn at jerusaleminstitute.org.il. And we look forward to working with you to develop innovative financial models to catalyze solutions that will finance the more inclusive economic growth. And thank you for being with us here today, and thank you all. We'll be working on the work streams and the work teams to try to also be supportive in getting this done. Thank you.
Thank you.
Thank you.
Bye.